Welcome back to the Free from Wall Street podcast. My name is Steven, and today we're going to be diving into what most people want to understand of the process of buying what we call a value-add multifamily syndication. There's basically 5 phases that we usually go through for real estate syndication. We like to talk about the 5 phases as the 5-paragraph essay structure from middle school. Remember that? So typically there's 5 stages of every single deal that we're going to do, and they all pretty much go the same way. Now, every deal is different, clearly, but the first phase is we got to acquire a property. So finding a property in this market is usually pretty difficult. We've been blessed to be working with some really good partners that have great deal flow. So us and our investors actually have more deals than we can fund at the moment, which is great news. But the acquisition of the property starts with kind of picking your market, figuring out why you like that market, looking for those particular projects, and then building those relationships with the brokers and letting them know what you're looking for. And then finally we kiss a lot of frogs, right? And then we finally put a letter of intent out that gets accepted. The letter of intent gets accepted. Then we have to put together the business plan. So we have to do the research, find the deal, do the projections, and then vet the sponsors' underwriting, vet the project calculations, and vet all of those things. And then when we say, okay, we're good, we're going to invest in this deal, then we bring in our investors as well, and we present the deal to you guys, and we show you what the deal is, why we like the deal, when we're closing on it, stuff like that. And then during that process, while we're under contract, we're bringing in the investor capital, getting ready for closing, and then doing a ton of due diligence, right? We're going out, we're walking every single unit, we're inspecting all of the roofs and HVAC systems and floors and doors and trim and all of those good things to make sure that our projections line up with the purchase price and the business plan. So that's step 1. Step 2, add value. So you'll hear us say multiple times over and over again, we like to buy value add multifamily projects. And that value add comes from a couple things that we do. One is management, right? Sometimes you take over a property and it has poor management fundamentals, and we can change the management and maybe increase the net operating income, decrease the expenses. So right away, we have our business plan, we close in the deal, and then we'll start renovations. If there's any down units, meaning unrented units, then we'll go in, we'll start turning those units. We'll do some upgrades to those units. We'll do exterior capital expenditures. So we're typically doing, sometimes we'll paint the exterior of buildings. Sometimes we'll do a brand new lighting package on the outside where we'll switch from the old style lights to a new daylight LED style lights, right? Safety is a big concern for us when we're buying these projects. And then typically these renovations last 12 to 18 months. So, sometimes when these units will turn, we will renovate upon attrition. So there's a certain number that are vacant when we buy it, and we'll do all of those right away. Then as people move out or leases expire, then we'll turn those units. And the reason that we're turning those units is because we really want to create value. We want to put linoleum vinyl plank in, right? We want to put new flooring, new doors, new trim, new paint, new kitchens, new bathrooms, depending on what the project is and how much of a rent premium we think we can get in that market. So typically we're trying to find something that is undervalued that we can put some value into and then achieve either market rent or a rent premium based on what we're going to be putting into the property. Sometimes we'll refinance, and that's phase 3. So depending on how long you hold these properties, you can sell them or you can refinance them. If we're going to do the refi stage, right, then we can go in, and if it's a heavy value add, we can do a heavy value add up front and then maybe refinance and recapture the investor capital. Because remember, we always talk about a couple of things that we want to do when it comes to capital. 1, capital preservation. 2, return on investment. And 3, return of capital, meaning velocity of capital. The more times you can put money in and out of a project and compound it, the faster that compound happens, the higher your rate and velocity of capital. So you can increase that compounding effect over time. So if we can create enough value where we can refinance and return capital sooner, we'll do that. And then we're going to hold the property, phase 4. So we're probably in years 2 or 3 by this point, and we want to hold it for another 2 or 3 years. And we've done the renovations, and now we're just doing maintenance. We're maintaining the property. We're decreasing expenses as much as we can, increasing income, and then we're holding it. We're cash flowing. We're creating generational wealth. We're creating passive income. That's the whole goal of making these projects work. So phase 4, it's the least risky phase. The property is stabilized. We're holding it for cash flow, and we're going to make sure that we're getting ready for phase 5, which is to sell. And we've done all of the updates. We've increased revenues. We got all the appreciation that we think we can get out of this property, and now it's 5 years older. So likely a new buyer will be able to come in, add some of their own value to it, and maybe reposition the unit a little bit for themselves. Or they'll buy it or sell it to a real estate investment trust, which just buys cash flowing, stabilized assets. And there's a lot of opportunities to sell these properties off market. You can do a 1031 exchange into the next project together with the other investors if you decide to. And then once the sale's complete, you get all your money back. You get a percentage of the profits, and we move on to the next deal. All of these phases for us are a lot of fun. We love the acquisition part of it because we like finding that diamond in the rough. We like doing the underwriting. We like adding the value to it because we're creating a nice place to live for the tenants and getting that cash flow up, and then holding it. Obviously, we get to reap the benefits. And then on the sale, we've accessed as much of the property's appreciation as we can. We're going to sell it. And now it's the best use of capital to go and do that again onto another project. So everybody asks kind of why 5-year horizons? And that's really why, because these 5 phases are typically completed in about those 5 years. Sometimes we hold things for 7 years. Sometimes we'll hold them for 10. But we always underwrite to a 5-year horizon, because if you think about it, if you're doing any rental bumps, any appreciation, then you're going to be seeing 2% per year. And if it's 2% per year over 5 years, that's pretty reasonable, pretty conservative. We're actually underwriting to 0% increases right now because of COVID. But if you're seeing 2% rental increases and you underwrite to a 10-year horizon, almost any deal is going to work, right? You're increasing the rental rates by 20% over time. So you will see that you'll be able to get significant upside on those deals.